In this video, I'm going to show you 5 popular high-yield dividend ETFs in Australia and how they compare against each other. Let's get straight into it. Alright, so here are 5 of the most popular dividend ETFs listed on the ASX. Each ETF ticker symbol appears on the top with the provider and official name below. All these ETFs track top Australian companies listed on the ASX that typically offer higher dividends compared to other companies. While they share a similar investment goal, each ETF uses its own unique method to identify companies likely to pay above average dividends. The first ETF on the table is VHY by Vanguard, which is one of the most popular and trusted ETF provider in Australia and the rest of the world. This ETF provides low-cost exposure to companies listed on the ASX that have higher forecast dividends relative to other ASX-listed companies. Then you have SYI by SPDR, another major ETF provider. This ETF is designed to reflect the performance of listed Australian companies with relatively high dividend income and quality characteristics with the potential for franked dividend income. Next, you have IHD by iShares BlackRock, which is another popular ETF provider. In fact, BlackRock are the world's largest ETF provider by assets under management. IHD is designed to measure the performance of 50 ASX-listed stocks that offer high dividend yields while meeting diversification, profitability, and tradability requirements, as well as being screened for sustainability considerations. Long story short, it's an ethical high dividend ETF. Next, you have RDV by Russell Investments. This ETF includes Australian blue chip companies with a bias towards those that have a high expected dividend yield, but also meet other characteristics including a history of paying dividends, dividend growth, and consistent earnings. And finally, we have ZYAU by Global X. They seek to invest in 50 high dividend stocks from the S&P and ASX 200 index. So basically, all 5 ETFs have the same objective, to maximize the potential dividends to their shareholders. Here are the inception dates showing when each ETF was launched and made available to investors. While an earlier inception date doesn't automatically make an ETF better, it does provide a longer track record and performance history. This gives investors more data to evaluate how the ETF performs across different market conditions. The first 4 ETFs each have at least 14 years of trackable data. ZYAU was originally launched in June 2015, but its inception date is listed as July 2023 due to significant change in their investment strategy at that time. These ETFs are ranked on this table based on their assets under management, or AUM for short. The AUM represents the total money invested in each ETF. The AUM grows as more investors buy into the fund. The AUM is important for 4 key reasons. 1. Liquidity. Higher AUM means the ETF is more liquid, making it easier to buy and sell. 2. Stability. Larger funds tend to be more stable and less likely to shut down. 3. Cost efficiency. Bigger ETFs can often offer lower management fees. 4. Popularity. AUM indicates how popular or trusted an ETF is among investors. As shown on screen, VHY has significantly larger AUM than the others, with the amounts decreasing across the page. Each ETF charges an annual management fee. For example, with VHY at 2.5%, you'll pay $2.50 in management fees per year for every $1,000 invested. Don't worry, you won't need to pay these fees directly. The management fees are calculated daily and deducted monthly from the fund, so they're already built into the ETF's daily share price. The management fees are fairly similar across all these ETFs, ranging from SYI 0.2% at the low end to RDV 0.34% at the high end. All 5 ETFs are domiciled in Australia, which means they are legally registered and regulated under Australian law. This makes it easier to work out your tax since you're likely already paying tax as an Australian resident. It also means you may be eligible for franking credits, which are only available from Australian companies. When an ETF holds domestic stocks and is locally domiciled, it can pass these franking credits to investors, potentially reducing your tax liability at tax time. All 5 ETFs pay distributions or dividends quarterly, meaning you receive payments 4 times per year. Just a quick note on the terminology. While dividends and distributions refer to the same type of payment, they are used differently. Companies pay dividends directly to their shareholders. For example, if you invested in CBA, they will pay you dividends. ETFs receive these dividends from companies they invest in and pass them on as distributions to their investors. So when you receive money from an ETF, it's technically called a distribution. Although people commonly use both distribution and dividend to mean the same thing. Please note, companies are not legally required to pay dividends, but funds like ETFs must pass on all distributions to their shareholders. Since all 5 ETFs are domiciled in Australia and pay distributions, they all offer a dividend reinvestment plan, or DRP for short. A DRP allows investors to automatically reinvest their cash dividends into additional units of the same ETF or shares rather than receiving cash payments. Here's an example. Let's say you own 100 shares of VHY, which pays a quarterly dividend of $2 per unit. You'll receive a total dividend of $200. If you opt into DRP, you receive $200 worth of new VHY units. So at the current price of around $75 per share, you'd get 2 new VHY shares. These new units will also generate their own dividends next quarter, further compounding your returns. The easiest way to set up a DRP is through a CHESS-sponsored broker. This gives you direct ownership of shares under your name and a holder identification number, also known as HIN. You can then use your HIN to set up a DRP with your share registry. I'll leave a link down below to a video on how to set up DRP if you're interested. By the way, if you're looking for an easy to use CHESS-sponsored online broker to invest in ETFs, check out the Moomoo app. They're a beginner-friendly online broker that allows Aussie investors to invest in both the Australian and US stock markets. Here are 3 things I like about them. 1. They're CHESS sponsored, which means your shares are registered directly under your name on the ASX. As previously mentioned, this allows you to set up DRP more easily. 2. They charge very low brokerage fees. They charge a minimum of $3 per trade for Aussie stocks and a minimum of 99 cents per trade for US stocks. This is one of the lowest rates in Australia. And 3. They've recently released an auto-invest function that automatically buys your favorite stocks or ETFs for every month or fortnight. This is ideal for beginners who want to automate their investing through a dollar cost averaging strategy and allows the app to do all the work. And since you're my audience, Moomoo has kindly organized some juicy sign-up bonuses for you. Right now, if you sign up using the link in the description, you'll receive up to 12 free random stocks when you make a qualified deposit and keep a minimum account balance for 30 days. You'll also get $0 brokerage fees for 30 days. So that's free brokerage fees for a month if you want to try out this app for free. And if you don't like it, no worries. You can simply withdraw your money and keep the free stocks. That's a pretty sweet deal. Please note, terms and conditions do apply, so please make sure you read them before proceeding. I'm not sure how long this offer will last, so if you're interested, use the link down below and claim all the free rewards on screen. If you're watching this in the future, I'll provide a link to the best current offer. The sign-up process itself only takes a few minutes, then you can start investing straight away. Enjoy. Let's now look at how each ETF performed over the last 5 years. Looking at the table, there are 3 key performance metrics to understand. First is the distribution performance, which is the average yearly return from dividends. Second is the growth performance, which is the average yearly share price increase. Third is the total performance, which is a combination of both. An ETF's total performance consists of 2 components, dividend performance and growth performance. Dividend performance shows your yearly percentage earnings from dividends, while growth performance indicates how much the share price has changed each year. These 2 components add up to give you the total performance. Among the 5 ETFs, VHY leads the way with the highest average annual return at 14.83%, while IHD has the lowest at 11.19%. This difference might be related to the company's holding selection, which we'll explore later. Please note that ZYAU launched in July 2023, so it doesn't have enough history for a 5-year performance average. You can check their website for their 2-year performance data. Looking back at the table, it's interesting that growth actually exceeded distributions on average for some ETFs like VHY and RDV. This may have occurred because during the pandemic, many companies reduced or stopped their dividends, yet share prices still went up due to increased investor demand. One last point I want to make clear is that these figures represent annual averages. Yes, averages. Take VHY for example. While it averaged 14% annual returns over 5 years, it doesn't mean it grew steadily by 14% each year. Some years brought bigger gains, others saw losses, and some had minimal changes. 14% represents the average yearly growth over the long term. This is crucial to understand, as many new investors mistakenly expect an ETF to deliver identical returns year after year. And please remember that past performances does not guarantee future results. If you invest in VHY shares today, the next 5 years may show different performance. So use historical data only as a guide. Next, we have dividend yields. The dividend yield of an ETF represents the income return an investor can expect to receive from dividends, expressed as a percentage of the ETF's current market price. So here's the formula. Dividend yield equals annual dividend per share divided by share price. The current dividend yield shows what each ETF paid out in the last 12 months. However, please be careful using dividend yield as your sole deciding factor when investing in an ETF. A higher dividend yield doesn't automatically mean the ETF is performing well. Most platforms calculate dividend yield using the trailing 12 months historical data. If a company cuts its dividend, the yield won't reflect future expectations. For example, if a company pays $1 in dividends last year with a share price of $10, the dividend yield is 10%. But if it's forecast to pay only 50 cents next year, the actual yield will be 5%, not 10%. The challenge is we can't predict future performance and how companies are going to pay. A falling share price can also inflate the yield. If a stock drops sharply in price, its dividend yield might look high, but this could signal trouble for the underlying company. The market might be pricing in a future dividend cut or poor performance. For example, if a stock falls from $20 to $10 but still shows a 6% yield, the dividend may not be sustainable given the company's declining value. Please remember, dividend yields are only a guide. They're not guaranteed. Even profitable companies aren't legally required to pay dividends to shareholders. While most profitable Australian companies choose to pay dividends to attract investors and increase their stock value, the final decisions remain at their discretion. However, ETFs are legally required to pass on the dividends received from the companies they invest in through the form of distributions to their shareholders. Next, let's look at the benchmark index. Each ETF tracks a different benchmark index that's regulated by ASIC and must meet ASX standards. These aren't just arbitrary indices that anyone can create. The ETF aims to mirror whatever the benchmark index does. If 2 ETFs track the same index, they should theoretically perform similarly, with the main difference being their management fees. While I won't go into detail about each index here, you can look them up online if you'd like to learn more. Next, let's have a look at the total holdings, which is the number of companies each ETF is invested in. VHY has the largest holding with 67 companies, making it more diversified than the others. This broader diversification typically means less volatile performance. IHD and ZYAU have the smallest number of holdings with 49 companies each. This could be due to their stricter selection process. IHD in particular, which is an ethical ETF, employs strict ESG screening criteria. But still, each ETF on the list contains around 50 or more companies, making them all well diversified. Please keep in mind that these holdings are not permanent. The ETFs review and update their portfolios regularly. Companies that no longer meet the ETF's performance criteria are replaced with better performing alternatives. And just for fun, I've listed the top 10 holdings for each ETF to give you an idea of what each ETF is about. These top 10 holdings make up about 50 to 80% of all holdings for each ETF. This isn't surprising given that Australia's top 10 companies by market cap are significantly larger than the rest. Please feel free to pause the video to examine the companies in detail. Each ETF takes its own approach to sector diversification. It's worth noting that in Australia, the highest dividend companies are predominantly banks and mining companies, sectors in which ETF on the list is heavily invested. By the way, if you want to see a complete list of all the holdings for each ETF or any other additional information, you can find it on each ETF's website, which I'll link down below. You can also download the fact sheet, which provides a concise summary of all the key information you need to make an informed decision. Let's now talk about franking credits. Franking credits are a tax offset that companies pay to shareholders along with dividends. When an ASX listed company makes a profit and pays a corporate tax, which is usually 30%, it can distribute part of the remaining profit to shareholders as dividends. If a dividend is franked, it means the company has already paid tax on that amount. As an investor, you receive a franking credit, which acts as a tax offset when you lodge your tax return, potentially reducing your tax bill. A fully franked dividend means the company has paid the full 30% corporate tax on the profits used for the dividend. Partially franked dividend means the company has paid some tax but not the full 30%. In this case, the franking credit is less than 100%. Since an ETF holds many companies, the franking credit percentage varies each quarter. So here's the 12-month average franking percentage for each ETF. Please note that franking credits only apply to dividends from profits taxed in Australia, which is why they primarily come from ASX-listed companies. If you want to check the historical franking percentages, you can visit this website, which I'll link down below, and search for the ETF. For example, let's look up SYI. Here are the last 4 franking percentages for SYI, which makes up the 80% average. I would encourage you to use this website to study historical data, not only for these ETFs, but for any ASX listed ETFs you're interested in. And quick disclaimer, this video is for educational purposes only and should not be considered financial advice. The ETFs I mentioned in this video are not buy recommendations and are only used as examples only. Investing involves risks, so please do your own research. Past performances does not guarantee future results. If you'd like financial advice, please go see a professional. By the way, if you're enjoying this video or made it this far, comment the words pocket money down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this awesome community of like-minded people. Also, please consider signing up for my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool updates from me. And if you're interested to learn how to invest in ETFs this year, check out this video on screen where I'll show you a beginner's guide on how to buy your first ETF. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.